everybody, and welcome to Traders Army's Wealth Essentials series. On this class, we're going to talk about the different investment vehicles available to help you to achieve your financial goals. When we look at different investment vehicles, one of the things that we have to take into account is which one is going to make the most sense for our personal situation. So what we're going to do today is introduce some of these investment vehicles, but then we're going to introduce a couple of different scenarios and how you might balance your portfolio based upon your individual needs. Now remember, as with anything, this is not to be considered financial advice. This is really educational in nature, and you certainly want to consult a licensed financial advisor if you have specific questions about what it is that you should be doing. So let's go and dive into this just a little bit. Now, when we talk about this, when we go to a destination, there are typically multiple vehicles that can get you there. A car, a train, a rocket ship, an airplane, an RV, a bicycle, a boat. There's a lot of different vehicles that can help you get to where you want to go. But you're going to use different vehicles in different situations, and different vehicles make more sense when you want to go faster, or when you want to go slower, or when you want to go safer, or when they're all going to be a little bit different to help you achieve your needs. And the same thing happens with our investment accounts. There's many different vehicles that we can use. Today, we're just going to introduce these vehicles, but we're going to have actually a course on each individual vehicle. So don't get too caught up in the fact that we're not going to go into a lot of detail in this session. This session is designed to be an overview. So let's go ahead and start with individual equities. And in this case, we're talking about stocks. And individual equities are the foundations of most portfolios. And they're typically either owned individually or as part of a mutual fund or an ETF. Historically, stocks will outperform most investments in the long run. And it's typically a blend of stocks. And those stocks can come from individual shares or, like we said, in mutual funds or exchange-traded funds. But the idea with the stocks is that we believe in our investment accounts that stocks are going to anticipate they're going to appreciate in value, and so that's where we would be investing. Not always, but individual equities in stocks do inherently take a bit more risk than trading in funds, because when I'm trading in an individual equity or an individual stock, I have not only the whole market risk, but I also have sector risk as well as that individual company risk. When you own a stock, you are actually a shareholder. You own a claim to a part of the corporation's assets and their earnings. And the amount of ownership is actually determined by the number of shares an individual owns relative to the numbers of outstanding shares, because you can buy as little as one share of a company. Matter of fact, you can actually buy fractional shares with some brokers. But as a stockholder, you typically get voting rights, but you do not get the right in case the company declares a bankruptcy or things like that. Stockholders are not going to be first on the list. So stocks definitely don't have the same amount of protection that a bondholder would have. But in exchange for that protection, you anticipate that you're going to have a higher rate of return, and that's why a stockholder would go in for there. So, like I said, we're going to do an entire section on stocks and how to look at them and how to find them and what to look for. But the thing about stocks is that they typically will have the highest amount of growth out of all these investment vehicles that we talk about. But with the more growth, you also take more risk and more exposure. Now, what if I just want to trade a basket of stocks? Well, a basket of stocks would be a mutual fund. A mutual fund gives small investors access to professionally managed diversified portfolios of stocks or of bonds or of other securities. And mutual funds are a very, very, very common way for individual investors to access the market. Now, as a mutual fund, you have a shareholder and you participate proportionally in the gain or the loss of the fund as a whole. When you buy and sell mutual funds, your price is actually not technically called the price, it's called the net asset value. And you can buy units of mutual funds. Instead of buying shares of a mutual fund, technically you buy mutual fund units, and they're redeemed at the net asset value. You purchase them at the net asset value, you redeem them at the net asset value. When looking at mutual funds, they're professionally managed, which means somebody has to put them together and somebody has to manage them. There's also a marketing fee tied with mutual funds because mutual funds have to be professionally marketed as well as managed. And all of those create costs. Costs become the biggest downside to a mutual fund because they eat into your return. They're typically the main reason why the majority of funds, they end up with performance less than the market in general. Funds do have their place in a portfolio in the right situation, and certainly we'll talk about those as we go through our Wealth Essentials series. The next is a bond. A bond is a debt investment. And in a debt investment, an investor loans money to an entity, whether it's a corporate bond or a government bond, and that entity, the corporation, the government agency, they borrow the funds for a predefined period of time. 1 year, 3 year, 5 years, 10 years. That would be the maturity date of that bond. Now, the idea is when you loan somebody money, you expect to get your money back, and you typically anticipate getting interest. So when you buy a bond, really what you're doing is you're being the bank, and you're loaning money to a company or a government agency, and you anticipate getting paid back with interest. Now, bonds have different ratings. Some bonds are AAA rated, some are AA rated, some are D rated. The higher the rating, the higher the probability that you'll actually get paid back. The biggest risk in a bond is a default of the bondholder, and then of the bond issuer. And then if that bond issuer defaults, then you could lose your entire investment amount. And that's why when we talk about investing, we talk about investment grade bonds versus what are commonly known as junk bonds, right? Junk bonds would pay a higher rate of return than an investment grade bond, but there's always that commensurate amount of risk with the rate of return. So bonds are used by companies and municipalities and states and the U.S. in order to finance a variety of projects and activities. And we'll talk a lot about what those are in our session around bonds. But for example, you can have a bond specifically designed to pay for a new toll road, right? That's what's called a revenue bond. And the bond interest is paid from the revenue generated by the new toll road. And that's typically going to be a municipal bond. Now, one of the benefits of a lot of those bonds, of those municipal and government bonds, is that some of them will grow in a tax-free environment, right? They'll grow in a tax-free environment. And a lot of people like that when utilizing those municipal bonds. And they're oftentimes called fixed income securities because you know how much you're going to get before you dive into it. So bonds are a very, very useful tool. Another very useful investing tool can be insurance products. Now, insurance products are primarily used for financial protection. But these insurance products that are primarily designed for financial protection, they also typically have some investment properties built in. The most common by far are annuities. And in annuities, they can be both fixed and variable. They have many, many uses for the right investor at the right time in their lives, but it has to be the right situation, the right scenario. Some annuities will be variable annuities, and they will go up and down. Some annuities that are more fixed will pay a fixed amount over a set period of time. Some annuities will reset a new floor so that they can only go up each year, and they participate in a percentage of an index's gain. There's a number of different types of annuities, and we will go over the different types of annuities in our annuity session. The other one is life insurance. Life insurance can be used as a hedge for future earnings in case of death. And that's really the main reason that people buy life insurance is for the death benefit involved. But they can also have an investment component. Some people will utilize things like universal life, which can have an investment component built in. Some people utilize the cash value of whole life insurance. And so insurance products are an important part to consider in your overall net portfolio, and we will cover each of those in more detail. The next one is real estate, right? Real estate can take many different forms for investors. Real estate can be held in an IRA, and when we talk about real estate, that real estate taking many forms can be, maybe you've got rental properties, and you consider those rental properties. You can have those rental properties inside of a retirement account. You can generate income and appreciation when you have that rental property. It can be commercial real estate, or it can be residential real estate. It can be single-family homes, or it can be multifamily apartment units. So there's a lot of different things that you can do with real estate, and real estate is really its own separate asset class. So we're not going to dive too deep into the details of real estate. You're certainly going to want to understand that asset class when you get in, but I think there's a lot to be said for having that as a diversification in your portfolio. Now, Physical real estate, by the way, is not the only way to invest in a real estate market. You can utilize a REIT, real estate investment trust. These are typically publicly traded real estate investment companies that you can participate in the gain or the loss of the real estate market. You can buy and sell individual notes, or you can wholesale properties. And so just because you're into real estate doesn't mean that you have to physically own that real estate or transfer that real estate. There are ways in order to do that. The next one are what are called ETFs, exchange traded funds. ETFs oftentimes go in with mutual funds, and we talk a lot about ETFs versus mutual funds, and we'll do an entire session on this. But ETFs, they offer me that same diversification that a mutual fund does, because they typically track a basket of assets, like an index or a mutual fund, but it trades like a stock on an exchange. The features of an ETF are the ability to short sell it, buy it on margin, and utilize options for hedging, leveraging, and speculation. And so the ETF, in my mind, gives me what the mutual fund does, but it gives me a lot more flexibility in its uses, and the fees are typically lower. The expense ratio for most ETFs is lower than the average expense ratio for a similarly constructed mutual fund. And so these are typically going to be used by investors in individual retirement accounts where they have a lot more control. Not always available in 401ks, but I think if you have the availability to move from that 401k into a self-directed retirement account, then an ETF is usually going to be a better option than a mutual fund based upon your situation. And then the last one we'll talk about here is options, and we're certainly going to talk a lot more about options as we go through this Wealth Essentials course. This is just high-level overview, but options were invented as insurance policies against equity positions, right? An option is invented as an insurance policy, and it gives the contract holder the right to buy or the right to sell 100 shares at a time for each contract that is owned. They're typically fairly low in cost, and they're very versatile trading instruments. They can be used as a hedging tool, or they can be used as a pure speculation tool. We believe that options are probably the single most underutilized tool for investors. And so we're going to talk a lot about how to utilize options as an investor. But when we think about all of these different vehicles, we want to understand how to construct a proper portfolio. And proper portfolio construction is going to be based upon each individual party's risk tolerances and their goals. And it's going to be a blend of investments that's going to lead to the right portfolio for that individual person. Overweighing on one asset can leave an investor open to too much exposure and to too much risk. So what we're going to do is we're going to look at 3 different scenarios. And these 3 different scenarios are each going to have a different portfolio construction that we can kind of dive in and talk about. Now, certainly your portfolio construction is going to look different than everybody else's. So you need to make sure that you fit the right portfolio construction that fits your asset class needs, that fits your goals, your risk tolerances, the capital you have out there. And once again, if you don't know what to do, consult a licensed financial advisor to kind of help you with that portfolio construction. So starting with this couple. So this couple, let's say that they're in their late 30s, and both of them are working. They're both working full time. You can see they've got their young son there and a nice puppy. Very happy in what they do. At least they look like it because they're smiling. But in your couple, you've got both parents working, and he's currently contributing to a 401k 10% of his paycheck, and that's $8,000 a year that's going into that 401k. And maybe it's 5% by him and 5% by the employer for the total of 10%. So they currently have about $175,000 in retirement. Their goal is to retire in their early 60s. So they have roughly 25 years or so until retirement. They do have a moderate appetite for risk. Now, combined, they make $120,000 per year, and they want to maintain a pretty similar lifestyle to what they have today. And when we look at that, we see, well, what makes sense for their portfolio? Well, remember that he's in a 401k, and most of their retirement is in that 401k. So that 401k, 75% of that 401k is equity-based mutual funds. 20% of it is in bonds, and 5% in cash. So what you can see here is that you've got 4 different mutual funds, a 500 index, a Vanguard Total Stock Market Index Fund, the American Funds Growth, the Fidelity Freedom Blend 2050 Fund, and then a Total Bond Fund, the Federated Bond Fund, and then a Government Money Market Fund. And you can see that the money is spread between those different funds, right? 35,000 to 3, 26,250 to 1, 14 to the other, 21,000 to the other, and then 8750 in cash. So this investor obviously has a higher appetite for risk because he's 75% long the market, right? 25% is held back into what are considered more conservative securities. And the idea is that balance might shift, right? As he gets closer and closer to retirement, that mutual fund, that stock mutual fund balance might go down, and the bonds and the cash might go up because your appetite for risk might change. Now, they've got a fairly healthy appetite for risk, which is why they've got 75% of their equities, 75% of their portfolio allocation is set to equities. Next, we've got a man in his late 40s. He currently has no money allocated for retirement. So when you have no money allocated for retirement and you're in your late 40s, now it's time to be a bit more aggressive, right? You're going to have to be a bit more aggressive if you really want to retire. If you're in your late 40s and you've got no money allocated for retirement at this point, it's going to take a much more aggressive stance in order to be secure in retirement. Well, this man's coming to $25,000 as an inheritance, right? Maybe an aunt passed away or a family member passed away and left an inheritance. And his goal is to aggressively grow that portfolio. And the reason he wants to grow that portfolio is because he wants to use that money as the base to start a business in the next few years. Because he knows he doesn't have enough money set aside for retirement, but really, really wants to be a business owner, but needs that money to grow. So if he wants to grow that money, instead of using mutual funds, he's going to want to use individual stocks. Now, those stocks that he's allocated that $25,000 between Uber, Facebook, and Home Depot, and notice that the highest amount there goes to Facebook. And then he's bought a couple of call options, Apple and ExxonMobil. And then 2 ETFs, the QQQs, and then XLY, which is our Consumer Discretionaries ETF. Now, this is a much, much more aggressive portfolio. This portfolio is a bit more aggressive as he anticipates growth from those individual stocks, taking some stocks that are a little bit more, let's call them tech-heavy, like Uber and Facebook and Apple, and then a couple of stocks that would be considered blue chips, like Home Depot or ExxonMobil, and then all rounding that out with some diversification utilizing exchange-traded funds. Now, this investor certainly would take a lot more risk, but he's anticipating a lot more gain. And so this could be a very high-performing portfolio if all of the stocks continue their movement the way he anticipates. Let's look at our third and final group. And our third group, they're a couple in their early 50s. Now, they're in their early 50s, and they've got about $750,000 in retirement. So they're closing in on retirement, and they are very risk-averse. They do want some upside growth, but they really want to protect what they've built. Now, in their goal, they'd like to have a second retirement home that they want to live in half the year. That's really an important goal for them, and so that's why they want to save as much as they can in order to get that goal achieved. But more important than saving is actually protecting, right? So this couple has decided that we're going to put 50% of our money into annuities, and they put their money into an annuity that is still has the ability to grow. But it's going to protect some of that downside investments. And then 20% into bonds, and then only 10% into stocks. And those stocks are all dividend-yielding stocks, looking to make money from a dividend yield in those positions. And then 10% is allocated towards cash. So they've got $75,000 just sitting in a money market account. That's just sitting in their money market account. No ticker symbol associated with that. It's just a money market account. $30,000 is allocated towards Microsoft, $25,000 to Coca-Cola, and then $20,000 to Home Depot. These are good blue chip stocks that are dividend yield stocks that these investors believe in and they're willing to keep and to hold because they're going to help to achieve their goals. They feel that they're safe stocks overall. Now, in reality, we know that any stock has the ability to continue to fall, and so as investors, it would be important, if you're very risk averse, to keep a close eye on this amount of capital. And then there's 2 annuities. And the bulk of their money is split between two annuities, a Great American Fixed Indexed Annuity and an Allianz 15-year fixed annuity. And these annuities are really designed to help them, keep their money safe and protected. They don't plan on using that money or taking it out, and so they're not worried about early termination fees in those annuities, and they're going to allow them to continue to grow where they are right now because they fit the goals of what they want to achieve. And then there's also about $150,000 in a bond fund. And that bond fund, they're looking for that bond fund to offer some protection as well as some dividends. So this couple has a different portfolio than the prior couple. All three scenarios are utilizing different vehicles, but they've all got one goal in mind: to live the life they choose to live life on their terms. And that's what I want to leave you with in this session. In this session, you have to figure out, okay, I know my number that I need to live life on my terms and to live life the way I want to because I did my retirement planning calculator, which we covered in session 1 of the Wealth Essentials class. But more importantly than that are what are the vehicles that I'm going to invest in order to help me live the life I choose to live. So as always, if you have any questions on this, you're going to want to send us an email, support@tradersarmy.com. If you need some specific advice, certainly consult your licensed financial advisor so that they can help you and guide you on the right path that makes sense for where you happen to be. If you're a more of a do-it-yourself style of an investor, then certainly make sure that you're educated in any of those asset classes, and we will be doing a session on each one of those asset classes that we covered today. Thanks so much, everybody. Hope you have a great day. See ya.